The digital debt clock dominates screens in trading floors, government offices, and living rooms across America, its numbers climbing with mechanical indifference. As 2025 draws to a close, the U.S. gross national debt stands at approximately $38 trillion, accelerating at an average of $8 billion per day. By early January 2026, it reaches $38.43 trillion as of January 7th, with projections pushing toward $38.5 trillion shortly thereafter. This relentless accumulation represents the cumulative legacy of fiscal decisions spanning decades, amplified by persistent deficits that now routinely exceed $1.7 trillion annually in projections for fiscal year 2026. This is the enduring irony of the post-Bretton Woods era. In 1944, the Bretton Woods Agreement established the U.S. dollar as the world's anchor currency, convertible to gold at $35 per ounce, with other currencies pegged to the dollar. It formalized American financial hegemony after World War II, granting the United States the exorbitant privilege of issuing debt in its own currency, while foreign governments and investors absorbed dollars through trade surpluses and reserve holdings. When President Nixon closed the gold window in 1971, the system transitioned to pure fiat dominance. Yet the dollar's status persisted, bolstered by deep capital markets, military reach, and the global demand for treasuries as safe assets. The advantages proved immense. The United States could finance large deficits at low rates, recycle petrodollars from oil imports, and sustain military expenditures that no rival could match. From the 1980s through the early 2000s, this framework supported expansion. Productivity gains from technology, globalization, and financial innovation drove growth. Debt rose, but so did perceived stability. Quantitative easing after 2008 and again during the pandemic masked underlying strains, keeping borrowing costs suppressed even as leverage increased. By late 2025, however, the structural tensions are no longer subtle. Net interest payments on the national debt approach or exceed $1 trillion annually, with fiscal year 2025 figures at around $970 billion, nearly tripling from $345 billion in 2020. Projections for fiscal 2026 place annual interest costs at or above $1 trillion, consuming a growing share of federal revenues and outlays. Debt-to-GDP ratios hover near or above 120%, a threshold that historically signals heightened vulnerability in reserve currency systems. Former Fed Chair Janet Yellen, in early January 2026 remarks, warns that the preconditions for fiscal dominance are clearly strengthening, where mounting debt pressures could force monetary policy to prioritize government financing over inflation control or employment goals. These dynamics echo historical late-stage reserve currency cycles. In ancient Rome, imperial overextension led to debasement of the denarius, reducing silver content to fund armies and bureaucracy, while persistent deficits eroded confidence. The Dutch Republic, dominant in the 17th century with the guilder as Europe's premier currency, shifted from creditor to debtor status in the 18th century as wars, colonial strains, and debt burdens forced reliance on foreign capital. Britain's sterling dominance waned after World War I, when war debts, loss of export markets, and resource pressures compelled borrowing from the United States, culminating in the 1931 abandonment of the gold standard. The United States in late 2025 retains core privileges. Treasuries remain the world's safe haven, dollar liquidity unparalleled, and alternatives like the yuan or euro lack depth. Markets price in confidence, term premiums stay contained despite warnings. Decision-makers monitor the feeds, the compounding math of interest, the daily debt increments, the geopolitical leverage still afforded by reserve status. Yet the pattern is familiar. Expansion gives way to debasement through deficit financing, then overreach as obligations mount. Venezuela provides the stark counterpoint. The country holds the world's largest proven oil reserves, approximately 303 billion barrels, representing about 17% of the global total and surpassing Saudi Arabia's 267 billion. Concentrated in the Orinoco Belt's heavy, extra-heavy crude, these reserves offer immense strategic value, though production remains suppressed at roughly 900,000 to 1.1 million barrels per day due to mismanagement, underinvestment, and long-standing U.S. sanctions. Oil prices in late 2025 and early 2026 fluctuate in the $57 to $61 per barrel range for WTI and Brent, reflecting global oversupply from non-OPEC producers and cautious demand outlooks. U.S. Policy toward Venezuela has evolved from sanctions targeting the Maduro regime over corruption, human rights abuses, and alleged narco-terrorism ties to more aggressive measures. Covert intelligence operations intensify through 2025, mapping Maduro's movements with precision, including routines, locations, and even personal details. Seizures of sanctioned oil tankers escalate, disrupting flows and heightening tensions. Opposition figures signal willingness to open energy sectors to foreign investment. Then, on January 3, 2026, at approximately 2 a.m. local time in Caracas, the night erupts. Explosions illuminate the sky as U.S. airstrikes, coordinated with more than 150 military aircraft from multiple branches, suppress air defenses at sites including La Carlota Air Base and Fort Tiuna Military Complex. Stealth drones and months of CIA surveillance guide the effort. Elite special forces, including Army Delta Force, descend by helicopter into Maduro's fortified compound at Fort Tiuna. Armed with tools like blowtorches to breach steel doors, they move swiftly. Nicolás Maduro and his wife, Cilia Flores, are captured within minutes as he attempts to reach a safe room. No American fatalities occur, though 7 U.S. service members sustain injuries. The pair is transferred to the USS Iwo Jima in the Caribbean, then to New York. Codenamed Operation Absolute Resolve, the action is framed publicly as a law enforcement operation against federal narco-terrorism charges, with Maduro and Flores indicted and pleading not guilty in Manhattan federal court on January 5. Yet U.S. leadership explicitly links it to strategic imperatives, reclaiming access to Venezuela's vast oil reserves, facilitating billions in investments by American companies, and securing long-term control over sales to offset damages and stabilize energy flows. In this precise, impersonal execution, the cycle reveals itself. A late-stage reserve power, burdened by debt climbing toward $38.43 trillion and interest nearing $1 trillion annually, undertakes a resource-focused intervention. Historical precedents resonate, not as moral judgment, but as structural mechanics. Empires in fiscal strain, turning to hard assets when monetary privileges strain against limits. The irony is profound. The same dollar dominance that enabled global projection now drives actions to acquire tangible resources amid compounding obligations. The debt clock ticks onward, markets absorb the development, analysts record the indicators. The stage illuminates a deeper unease beneath the surface confidence. The debt clock, once a curiosity displayed on websites and news tickers, has become a fixture in the consciousness of macro observers by early January 2026. As of January 7, the total gross national debt registers at $38.43 trillion, up $2.25 trillion from the same date a year prior, an average daily increase of $8.3 billion over the past 12 months. This pace compounds relentlessly, $334 million per hour, $5.57 million per minute, a mathematical inevitability that no policy pronouncement has yet reversed. Interest on the debt, the silent accelerant, has crossed into new territory. Net interest payments for fiscal year 2025 reached approximately $970 billion, with projections for fiscal 2026 placing annual costs at or above $1 trillion, consuming an ever larger portion of federal revenues and outlays, forecast by the Congressional Budget Office to rise to 13.85% of total outlays in FY 2026. These figures are not anomalies. They represent the logical extension of post-1971 fiat dynamics, where reserve currency status allowed sustained deficits without immediate market punishment. Yet the privilege erodes under its own weight. The debt-to-GDP ratio hovers near or above 120%, a level that has historically invited scrutiny in prior empires. Former Fed Chair Janet Yellen, speaking at the American Economic Association panel on January 4, 2026, delivered the warning with measured gravity. The preconditions for fiscal dominance are clearly strengthening. She described a scenario where mounting debt pressures could subordinate monetary policy to fiscal needs, keeping rates artificially low to minimize servicing costs rather than to control inflation, raising term premiums, elevating borrowing costs, and risking entrenched inflationary expectations. Yellen emphasized that while the United States had not yet entered full fiscal dominance, the trajectory toward debt levels exceeding 150% of GDP over coming decades made the risks real and worthy of close monitoring. This language resonates with historical precedents. In the late stages of reserve currency cycles, impersonal mechanics assert dominance over policy discretion. The Roman Empire's debasement of coinage, reducing silver content in the denarius from nearly pure in the early empire to less than 5% by the 3rd century, funded military campaigns and bureaucratic expansion amid fiscal strain. Confidence eroded gradually, then precipitously, as inflation and loss of monetary integrity undermined the system's foundations. The Dutch Republic, Europe's financial hegemon in the 17th century, transitioned to debtor status in the 18th, as prolonged wars, colonial overextension, and rising debt burdens forced reliance on foreign creditors, ultimately ceding primacy to Britain. Britain's sterling era ended in the interwar period. World War I debts, loss of export markets, gold outflows, and resource strains culminated in the 1931 suspension of gold convertibility, marking the transfer of reserve status to the dollar. In the American context of January 2026, the pattern manifests in data streams rather than dramatic rupture. Markets still absorb Treasury issuance at contained yields, reflecting residual confidence in the dollar's depth and liquidity. Yet subtle divergences appear. Millionaire migration statistics for 2025 show a record 142,000 high-net-worth individuals relocating globally, the highest number ever recorded, with net outflows from traditional centers like the United Kingdom, projected at 16,500 departures, and inflows to tax-stable hubs such as the UAE, net gain of 9,800, and the United States itself, net gain of 7,500, though tempered by domestic fiscal concerns. These flows represent quiet diversification, wealth-seeking jurisdictions with lower exposure to fiscal strain and policy uncertainty. The January 3rd operation in Venezuela amplifies the unease. Operation Absolute Resolve, executed with more than 150 military aircraft, stealth drones, and elite special forces, captured Nicolás Maduro and Cilia Flores in minutes at Fort Tuna, with the pair transferred to the USS Iwo Jima and then arraigned in New York on January 5th on narco-terrorism charges. Public framing as a law enforcement action against drug trafficking contrasts with explicit statements tying the intervention to strategic resource access. Venezuela's 303 billion barrels of proven reserves, the world's largest, offer potential value at current prices of approximately $57 to $61 per barrel for WTI and Brent equivalents. As of January 11th, oil markets registered WTI around $59 per barrel and Brent near $63, with limited immediate volatility from the event. Analysts attribute stability to global oversupply dynamics and the recognition that reviving Venezuelan production would require years of investment amid decayed infrastructure. The contrast sharpens the tension. Reserve currency advantages, low borrowing costs, global demand for dollar assets persist, yet they coexist with exploding interest obligations and explicit resource pursuits. Macro analysts log the alignment. Debt growth outpacing GDP, interest nearing or crossing $1 trillion annually, Yellen's explicit warning on January 5th, and historical parallels where late-stage powers turned to asset acquisition when fiscal math tightened. Observers note the impersonal nature of the cycle, not driven by ideology but by structural limits, the need to offset damages, secure energy flows, and potentially reimburse obligations through hard assets. Geopolitical responses underscore the stakes. China and Russia condemn the action as aggression, violating sovereignty. Regional powers express concern over precedents. Yet, the U.S. proceeds, highlighting the mechanics at play. When monetary dominance strains against fiscal realities, interventions framed as security measures serve dual purposes: law enforcement and resource leverage. The indicators deepen. The debt clock advances, interest accrues, warnings resonate. History's patterns, once distant analogies, now appear in real-time data feeds and official statements. The unease is structural, not sensational, the slow realization that unipolar advantages, while formidable, face mounting tests from within. By January 11, 2026, the digital feeds display an unyielding reality. The U.S. gross national debt stands at approximately $38.433 trillion as reported on January 7th, with the daily increment averaging $8.3 billion over the prior year, translating to roughly $334 million per hour in compounding obligations. Projections indicate continued acceleration, with the debt potentially reaching $39 trillion by early April if recent trends hold. Net interest payments, having reached around $970 billion in fiscal year 2025, are now forecast to hit or exceed $1 trillion annually in fiscal 2026, according to Congressional Budget Office estimates. This places interest costs at roughly 13.85% of total federal outlays for the year, a share that continues to crowd out discretionary spending and signals deepening fiscal strain. Janet Yellen's January 4th warning at the American Economic Association panel resonates with increasing clarity. The preconditions for fiscal dominance are clearly strengthening. She described a trajectory where the sheer scale of debt, on course toward 150% of GDP over coming decades, could pressure monetary authorities to prioritize low interest rates for debt servicing over inflation control or full employment goals. Such dominance, she noted, risks elevating term premiums, raising borrowing costs, and entrenching inflationary expectations as investors question whether fiscal needs will subordinate independent policy. While the United States has not yet crossed into full fiscal dominance, Yellen emphasized that the dangers are real, warranting close monitoring amid political pressures and structural trends. These warnings align with observable fractures in long-held assumptions of reserve currency invulnerability. Markets still price treasuries with relative calm, reflecting the dollar's liquidity and depth, yet subtle divergences emerge. Millionaire migration data for 2025, as tracked by Henley & Partners, projects a record 142,000 high-net-worth individuals relocating globally, the highest number on record, with net outflows from centers like the United Kingdom, 16,500, and inflows to tax-stable jurisdictions such as the UAE, 9,800, and the United States itself, 7,500. These movements represent quiet repositioning, wealth-seeking environments with lower exposure to fiscal uncertainty, policy volatility, and potential erosion of privileges. Geopolitically, Operation Absolute Resolve continues to ripple. The January 3rd raid, executed with over 150 aircraft, including F-35s, stealth drones, and Delta Force helicopters, captured Nicolás Maduro and Cilia Flores at Fortune in minutes, amid airstrikes suppressing defenses at sites like La Carlota and military installations. The operation, framed as enforcement against narco-terrorism charges, with arraignment in New York on January 5, carries explicit resource implications. Venezuela's proven reserves remain at approximately 303 billion barrels, the world's largest, comprising about 17% of global totals, far exceeding Saudi Arabia's 267 billion. Production, however, languishes near 900,000 to 1 million barrels per day due to chronic underinvestment and sanctions effects. As of January 11th, oil prices show limited disruption from the event. WTI trades around $59 per barrel, Brent near $63, reflecting broader oversupply dynamics from non-OPEC producers and cautious demand forecasts. Analysts note that reviving Venezuelan output to meaningful levels would require years and hundreds of billions in investment, challenges that temper immediate market reactions. Yet the intervention underscores a pattern: late-stage powers pursuing hard assets when monetary advantages strain against fiscal limits. China and Russia condemn the action as sovereignty violation. Regional actors express concern over precedents. U.S. statements emphasize strategic energy access, potential billions in American investment, and long-term control to offset damages and stabilize flows. Macro observers, those tracking debt math, interest trajectories, and historical cycles, increasingly recognize the convergence. The seven-stage framework: sound money, expansion, debasement, resource acquisition, confidence erosion, fiscal dominance, reset, places the current phase firmly in resource-focused action amid early confidence questions. Debt growth outpaces real GDP, interest obligations approach trillion-dollar thresholds, explicit warnings from figures like Yellen highlight preconditions. Parallels to prior empires sharpen: Rome's coinage debasement to fund overreach, Dutch reliance on foreign capital as debts mounted, Britain's interwar shift from sterling primacy amid war burdens. The tension deepens not through spectacle, but through data streams and official language. Reserve privileges endure, dollar demand, treasury absorption, but coexist with mounting pressures. Compounding interest, migration signals of diversification, and geopolitical moves to secure tangible assets. The cycle's mechanics, impersonal and inexorable, reveal fractures in assumptions of indefinite dominance. Observers log the indicators, historians note the echoes. The unease is structural. The recognition that unipolar advantages, while formidable, face internal tests that historical patterns suggest cannot be indefinitely deferred. As of January 11th, 2026, the U.S. gross national debt registers at approximately $38.43 trillion, based on the latest available Treasury data from January 7th, with the average daily growth rate holding steady at around $8.3 billion over the preceding year. This equates to roughly $334 million per hour in new obligations, a mechanical progression that continues to outpace real economic output in structural terms. Net interest payments on the debt, having reached about $970 billion in fiscal year 2025, are now projected by the Congressional Budget Office to reach or exceed $1 trillion annually in fiscal 2026, representing approximately 13.85% of total federal outlays and marking a new threshold where servicing costs crowd out other priorities at an accelerating pace. Janet Yellen's January 4, 2026 remarks at the American Economic Association panel remain the most explicit official signal of shifting dynamics. She stated that the preconditions for fiscal dominance are clearly strengthening, describing a scenario where the scale of debt, on a trajectory toward 150% of GDP over coming decades, could compel monetary policy to prioritize minimizing government costs through lower rates, rather than strictly controlling inflation or supporting full employment. Such subordination, she warned, would likely elevate term premiums, raise overall borrowing costs, and risk entrenching inflationary expectations as markets question the independence of monetary authority. While the United States has not yet entered full fiscal dominance, Yellen underscored that the dangers are real, warranting vigilant monitoring amid political and structural pressures. These indicators converge with the ongoing execution of Operation Absolute Resolve. Initiated on January 3, 2026, at approximately 2 a.m. local time, the operation involved more than 150 military aircraft, including F-35s, stealth drones, and special operations helicopters, coordinating airstrikes to suppress Venezuelan air defenses at sites such as La Carlota Air Base and Fort Tiuna. Elite Delta Force units descended into Maduro's compound, capturing Nicolás Maduro and Cilia Flores within minutes amid attempts to reach a safe room. No American fatalities occurred, though 7 service members sustained injuries. The pair was transferred to the USS Iwo Jima in the Caribbean, and then to New York, where they were arraigned on January 5 on federal narco-terrorism charges, pleading not guilty. Publicly framed as a law enforcement action against drug trafficking, the intervention carries clear strategic resource dimensions. Venezuela holds the world's largest proven oil reserves, approximately 303 billion barrels, accounting for about 17% of the global total and surpassing Saudi Arabia's 267 billion, primarily in the Orinoco Belt's heavy and extra-heavy crude. U.S. leadership has tied the action to reclaiming access, enabling billions in American company investments, and securing long-term control over sales to offset damages, disrupt illicit flows, and stabilize energy security. As of January 11th, oil markets reflect minimal immediate disruption. WTI trades around $59 per barrel, Brent near $63, with stability attributed to global oversupply from non-OPEC producers, and the recognition that meaningful production revival would demand years of investment and hundreds of billions to address decayed infrastructure. Early confidence indicators flash subtly amid these developments. Millionaire migration data for 2025 recorded a record 142,000 high-net-worth individuals relocating globally, with net outflows from traditional hubs and inflows to tax-stable jurisdictions, signaling quiet diversification away from perceived fiscal and policy risks. Geopolitical condemnations from China and Russia label the operation as sovereignty violation, while regional responses highlight concerns over precedents. Yet the U.S. proceeds, underscoring the mechanics. Reserve currency privileges, deep treasury liquidity, global dollar demand, coexist with exploding interest obligations and explicit pursuit of hard assets. The pattern echoes historical late-stage cycles. Resource acquisition emerges when fiscal strains test monetary dominance. Debt growth compounds, interest crosses trillion-dollar thresholds. Official warnings on fiscal dominance preconditions are explicit. The cycle's impersonal forces, overextension, debasement, asset pursuits, assert themselves in real-time data and actions. No rupture has occurred, but the alignment of indicators deepens structural unease. In monetary and geopolitical history, unipolar advantages are being tested, not yet eroded. Influence is contested not by strength alone, but by alignments of debt, resources, and confidence that make sustained privilege more challenging in real time. Follow for updates as these real-time indicators evolve.